put together another Taking Stock think tank to try to figure out what's been going on with the global economy and its future. We have Mike Englund. He is a chief economist at Action Economics. He is rated a Bloomberg best for his analysis of the economy. Also with us, McCarthy, chief financial economist at Jefferies Company, and right back from Russia, Odessa, we have Charles Ortel, managing director, Newport Value Partners. All right, let's start with you, Michael Englund. Give us the lowdown on the U.S. economy. The Philadelphia manufacturing numbers, not so great. Existing home sales, also terrible. Take a look at the jobless claims numbers, not so great there either. Is there any good news in the U.S. economy right now?
Well, certainly the outlook is bleak, and we're facing a pretty severe financial panic. Whether or not that's going to translate into an actual economic panic is unclear. That's what happened after the Lehman crisis in 2008. I would differentiate the patterns we're seeing in some of the recent data, the hard data, vehicle assembly data we can track weekly. The initial claims numbers you cite, they're really not that bad. We clearly are in a weak patch through the third quarter, but we look at positive growth if we are only looking at hard indicators. The problem is if we look at confidence measures, you mentioned the Philly Fed index, that plummeted. That's a gauge of people's perceptions, very simple questions asked of people in that industry. We've also seen the Michigan Sentiment Index numbers fall pretty sharply. So the market is seeing a panic in perception. The real question is whether that's going to translate to an actual reduction in consumer spending, business investment, and that we have yet to really see.
McCarthy, are we going to talk ourselves into another recession here?
Well, it seems like that's what some people are trying to do, and it seems like we're also psyching ourselves into that possibility. What I do think will happen is over the next 4 to 6 weeks, we will see some of those soft numbers that Mike was talking about translate into some weak economic data. But I think in the end, the underlying core of the economy will, prevent us from sinking into a recession. But we can't keep doing this for an indefinite period of time without it finally being reflected in some damage in the real side of the economy.
Charles Ortel, I got to think you've been looking at the data and you only see black news ahead.
Now, come on, Pimm. You know I'm an optimist.
All right, tell us the truth here. All right, what do you think?
I think that the GDP is a deeply flawed statistic, and that when most economists talk about the health of economy, they focus on that statistic. A much better number, in our view, for the modern economy, one that has such a large public sector involvement, is true private sector incomes per household. And if you look at that statistic, whether you look at it nominally in so-called real terms or adjusted to gold or some other measure of value, that statistic has been falling off a cliff since about 1997.
People are just not making any money.
And it's obvious why. I mean, I'm afraid to say that that amiable person, Ross Perot, who talked about the giant sucking sound, didn't really have it exactly right, because he was only focused on Mexico. And the real sucking sound is jobs out of the U.S., out of the advanced economies, into China, into India, into frontier markets. And that is only going to continue for as long as you can see.
Mike Englund, a report today from Morgan Stanley, I've got it right here, saying that they are reducing their economic outlook for the United States sub 2% for 2.25% for next year, sub 3% growth in the United States for this year. Does that sound like a recession to you?
Well, obviously it's positive growth, so I wouldn't call it a recession. It does indicate that the public will be quite disturbed about the economic path over the period if that really does unfold. To a certain degree, that is extrapolating the kinds of tensions we're seeing in the financial market over the last few weeks, and I guess time will tell whether that will occur. I'd make the point that the third quarter GDP number is probably coming in close to a 2% number. Some people have revised down that figure, and if we got a very lean number in the third quarter, that probably would perpetuate this panic sense. The bounce in the vehicle sector is a very real bounce. It comes off a temporary lull in the second quarter. That's going to provide some lift to the factory data this quarter. Hopefully that breaks this cycle of bad news and of panic that's really taken hold of the stock market and the bond market.
McCarthy, breaking the cycle of bad news, is that going to be reflected in the price of gold, or does gold just march higher, do you think?
Well, gold is on a tear, and as long as confidence is as shaky as it is right now, probably gold's going to continue to trade well, and so are U.S. Treasuries. Because right now the problem is investors just don't know what to trust. The only things they know...
No faith.
There's no faith. There's no faith in the government. In fact, the Western leadership has perfected the art of staying behind the curve as far as dealing with economic problems are concerned. And frankly, that's really at the heart of at least the extent of the deterioration we've seen in the market recently. There are some structural problems that we have, I agree, on that front. For example, 85% of U.S. labor force is involved in the service sector. We need to have better balance balanced than that. But right now, we just need a little bit of calm, and it would be really helpful if somebody who is in a position of governmental importance would do something right for a change.
Ward McCarthy, you talked about this idea that maybe we just need a little bit of calm in the market. How can you get calm in a market where trading has taken over from investing? When you take a look at daily volumes, that's not investing, is it? I mean, this is short-term trading that's run by machines.
Well, it is pretty much, short-term trading. That's very reactionary. I mean, based on the volumes, it doesn't seem like investors are really doing much of anything. They're just sort of sitting back and see where all of this ends up. And eventually, it will run out of steam. But there also is a way to stop it, and that is for governments, whether it be in Europe or whether it be in Washington, to make some intelligent decisions. And
what, like banning short selling?
Well, not like banning short selling, but like actually, as I mentioned before, getting ahead of a problem rather than constantly being behind it. So, for example, in Europe, if the ECB were to act really forcefully in providing support for some of the peripheral markets and continue to do so and have to convince investors that that's what they were going to do, that could help. In the U.S., if the leaders in Washington said, okay, we made a mistake, we should have adopted the Bowles-Simpson plan and we're going to take it. Now, because the economy is in trouble, we're going to push out the start date a couple of years just so we can get the economy going. But if we had that kind of leadership, that would calm things down and would make people feel a lot better about the future.
Charles Ortel, leadership in Europe, any chance that we're going to get this from Angela Merkel, Chancellor of Germany, Nicolas Sarkozy, President of France? Are they going to band together and really do something more than hold press conferences?
Probably not. I think we'll get the optics of leadership after we get the end of the summer. But the truth is, Pimm, I think that if you go back to maybe 1989, 1991, the basic business model of government in these advanced economies, in Japan and Europe and the United States, is deeply flawed. You cannot redistribute wealth forever by overpaying too many public sector workers who are not accountable to anybody, way too much money. We have a deficit in this country. It's not as advertised. The total spending is $5.6 trillion across federal, state, and local communities. And our deficit's running at about $1.5, $1.6 trillion. That's crazy stuff. We don't have a budget right now. I mean, there should be much more accountability in Washington, and it's coming, not soon enough. It's coming in 2012. I think there's going to be a pitched battle between now and then over the future of this country.
Michael Englund, doesn't this just highlight the debate that has been continuing in Washington over whether you do some kind of short-term fix to the economy in order to get it growing again, and then you worry about doing the severe budget cuts later on? Is that going to be resolved?
Well, I think there's a real dichotomy in views of the world, and I think people that are on the Keynesian side of the divide tend to think that there's a trade-off between cutting spending and slowing the economy. They don't want to cut spending too fast because they think the economy will slow. For those on the other side of the fence, the notion is the deficit is so large that government spending has actually contracted private spending by more than it's boosted government employment. So the net effect of these large deficits is to contract the economy. From that standpoint, of course, aggressive cutting would be the solution. The one obvious quick fix to this dilemma is to address entitlement reform. That's hard to do just before an election year. But by entitlement reform, you can cut spending 5, 10, 15 years down the road. You don't have cuts in current spending, and politicians can take credit for solving the deficit dilemma. The Bowles Commission, to a large degree, has that component to it. If the White House were to move toward accepting some entitlement cuts, I think the market could improve fairly substantially.
Mike Englund, which side of the fence do you come down on? I mean, is it possible you're like an artist holding two contradictory ideas and still functioning?
Well, my own opinion would lie on the other side of the fence. I do think the government has overspent on the fiscal side with its Keynesian experiment, and I think the Keynesian experiment was not constructed very well. Most of the spending was transfer payments. It didn't go to direct government spending, targeted to be spent quickly, and as a result, we boosted the deficit without necessarily getting the sort of Keynesian experiment you might want. So I personally think that a big cut in spending, especially if it is in the out years, but I think if it was in the near years as well, would have a positive effect on the private sector. It might surprise a lot of Keynesians out there to see the economy accelerate on government spending cuts.
Some final thoughts, Ward McCarthy. In the absence of any rational calm that could descend on the market, what happens to something like the U.S. dollar versus the euro? I mean, is it a surprise to you that the euro stayed this strong?
Well, actually, that's an ugly contest at this point in time. And yes, it does surprise me that the euro stays so strong. primarily because a weaker euro would really help them out a lot in this particular situation. But the Europeans seem to be determined to try to support their currency. Whereas in the U.S., it has been sort of an unspoken policy for at least 3 years now that we'll be very happy to have the dollar to continue to depreciate, primarily because it helps us become a little bit more competitive in the international markets.
Are we going to have to spell drachma all over again? New Greek economy, the old is new again?
Yeah, we may. You may see something as extreme as some countries dropping out, and then once they get their fiscal houses in order, coming back in. But at this point, it's really difficult to figure out exactly how that's going to play out.
Michael Englund, what do you think is next for the U.S. dollar? Michael Englund?
We are generally looking for a downtrend in the dollar. Yes?
Go ahead.
Can you hear me?
Yep, go ahead. Tell us about the dollar and the greenback.
Yeah, we agreed with Ward, and we are looking for a general downward trend in the dollar. We think as long as we have an imbalance on the government balance sheet, and as long as we have a lack of clarity as to where the elections are going to go in 2012, there's really going to be little prospect of improving the fundamentals for the dollar. There could be a bit of a race between the dollar and the euro, as there are multiple currencies in the world now that have a propensity to be weak, but we think the dollar is likely to win that race and have a downside bias for at least a year or two.
And Michael Englund, what happens at Jackson Hole? Any change in Federal Reserve policy? Do they come riding to the rescue with a white hat?
Well, I think any possibility of them trying to float or push a QE3 has probably been truncated by this last round of very ugly CPI data. In general, I think they know the market would have a somewhat hostile response to QE3. Like with fiscal policy, there are really two camps in the market. There's some people that love the idea of the government buying up securities, and some hate it. And I think they realize they get punished pretty severely from those that are critical about the Fed's ability to get out from underneath this enormous portfolio they've built.
Charles Ortel, the U.S. dollar, what happens next?
Well, unfortunately, I think that the Federal Reserve at this point is all hat, no cattle, and I don't really think they can. They have the wherewithal or the gumption to do what really is required at this stage, and that's, in my view, a very different approach. That's to have a strong dollar, not a weak dollar. Our household net worth is many, many times the value of our exports. We're going to have a hard time increasing our exports, no matter what we do. Competition in China and India and other places is very, very tough. So I would actually be much more in favor of saying to the world, look, your capital's safe inside the U.S. We're changing course. We're going to lower taxation. We're going to keep capital safe here. And I think you'd see a very surprising result.
All right, maybe we'll get you that horse and we'll send you out to Jackson Hole. I want to thank you very much. Charles Ortel, Newport Value Partners, Ward McCarthy joining us from Jefferies, and Michael Englund from Action Economics.